when a business starts, the accountant comes into play. He gives a special status to the business by applying one equation. What is that equation? Assets is equal to liabilities plus capital. Correct? And due to this business entity concept, business becomes the first party. And this. And these liabilities are third parties. And this capital is the amount contributed by the owner or owners. He may be proprietor, partner, shareholders, etc. And this is the equation of the business. And in valuation of goodwill, we will eliminate all those belonging to the third parties. And it is an affair between the second party and the first party. And this is debit, and this is credit, and this is credit. So a business consists of assets only. Out of the assets, how much amount belongs to the third party? That may be settled. The rest belongs to the owner or owners. That is why this capital is otherwise called as equity. The owner's right in the business. But here we will say net worth. And this business consists of assets. It may be fixed or current assets, or non-current assets or current assets. And these assets, non-current assets, may be tangible assets or intangible assets. And there are another classification. Fictitious assets are there. They are not actually assets. And out of these assets, the value belonging to the liabilities are settled. The rest belongs to the owner or owners. It may be called reserves and surplus. And from these assets, if we deduct liabilities, amounts due to third parties, we get net worth or equity. And here the net worth is the subject matter of valuation of goodwill. So, in valuation of goodwill, subject matter is net worth. And this is business. The net worth is the business. And this net worth is valuing here. So the subject matter of valuation of goodwill is what? Net worth. And net worth is assets minus liabilities is equal to net worth. So in any balance sheet, net worth can be easily calculated. From the assets, deduct liabilities. We get a net worth. Or capital plus reserves and surplus is also net worth. Two approaches may be there. And as per the balance sheet, or the balance sheet is based on cost concept, or it is an historical cost method. The values may be different. Thus we know net worth increases because of profit earned during a period. And without profit, net worth never increases. So this net worth contains capital plus profits, that is reserves and surplus. From the assets, if we deduct liabilities, we get a net worth. And assets having debit balance, liabilities credit, and net worth is also credit. In between, over a period, there is one more debit and credit, and that is expenses and incomes. And these expenses and incomes are set off, and the net result is taken to the balance sheet. If it is net profit, it will be shown on the liability side of the balance sheet under the head reserves and surplus. So the net worth tells everything. When a business net worth increases, the value of the business also will increase. If there is no additional capital, the net worth increases primarily due to the profitability of the business. So the profitability and net worth is interconnected, closely related. Capital increases because of profit, simple. So the value of the business thus primarily depends upon its profitability. Without profit, net worth never increases. That is, the value of the business never increases. Simple. Valuation of goodwill is over now. But we need to adjust some values. This is a balance sheet. Say X Limited. X Limited. And this balance sheet contains certain assets and liabilities. When a new person comes to buy this business, he decides to buy this business. Business means what? Net worth. He comes to buy this business. All the assets and liabilities will be taken into account. Here business means assets minus liabilities. But in valuation of goodwill, these assets will be revalued because all these assets are showing in their cost less depreciation. Cost less depreciation. And this valuation based on a fair valuation. There are different methods of valuation of assets. And all the assets and liabilities will be revalued. And he will consider only assets. Consider only assets. See, look into this balance sheet. There are two items. Preliminary expenses and discount on debentures. Preliminary expenses and discount on debentures. These are fictitious items. First, that will be eliminated. Then the remaining assets will be revalued. If a separate quote is available in the market, that price may be taken. For investments, etc., separate quote is available. He will revalue buildings, plant, investments, book debts, all current assets, fixed assets, everything will be revalued. First, eliminate all the fictitious assets, deferred expenditures. The assets, see the patents and trademarks, it is an intangible asset. It is an intangible asset. then all the assets will be revalued. From this, deduct liabilities assumed. And the values of liabilities deducted, we get net worth for the valuation of goodwill. Net worth for the valuation of goodwill. Two approaches may be there, asset side approach and liability side approach. This matter will be discussed later. So from these revalued assets, deduct third parties liabilities. Here third parties liabilities are creditors, debentures and workmen profit sharing fund. Workmen's compensation fund is a part of reserve. If there is any liability pending, that may be deducted. So these liabilities will be deducted from the assets taken over. It may include intangibles also. But if there is any goodwill in the books, it will not be considered for valuation of goodwill. And this goodwill we are going to value. So this will not be considered. We will discuss it later, everything. And here we get the first definition of goodwill. That is excess purchase consideration. The purchase consideration paid over and above the net separable assets taken over. Net separable assets taken over. That is the first definition of goodwill. If the assets, net assets of this particular company, say 8 lakhs, and if the buyer, new buyer, the new owner pays more than 8 lakhs, the difference will be treated as goodwill. Difference is treated as goodwill. The consideration paid over net assets acquired. Here better we call it as net separable assets. Net separable assets. That is the first definition of goodwill. This is called purchased goodwill. Purchased goodwill. And goodwill showing in the balance sheet will be always purchased goodwill. Thus, goodwill is defined as the difference between value of a business as a whole. Value of a business as a whole. That is called purchase consideration. Purchase consideration. And the aggregate value of the fair value of separable net assets. Net assets means assets minus liabilities. So the difference between the value of the business as a whole and the fair value of separable net assets. And here it is the excess purchase consideration transferred over the fair value of assets acquired and liabilities assumed. Assets minus liabilities. Another definition is, see here we studied some excess price is paid over net asset acquired. Why this excess price? Or how this excess price will be calculated? That calculation is based on the profitability of the business. Profitability of the business. The excess price paid for is calculated on the basis of extra earning capacity of the business. That is why the new owner comes and buying this business. This business has a speciality, or the business is enjoying certain advantages over other business in the similar industry. That is why he is buying this business. This business enjoys certain advantages. And that definition is the value of the reputation of a business. Value of the reputation of a business. Here reputation means advantage, certain advantages enjoyed by the business. Not just reputation. this business enjoys advantages, certain advantages or benefits over other business in the similar industry. That is called reputation. And the value is placed on the reputation of a business. And this value is based on the excess earning capacity. And that is expected in future, profits expected in future over and above the normal level of profit. So here it is excess earning capacity. Excess earning capacity. And this excess earning capacity is profits expected in the future over and above the normal rate of earnings. That is called excess profit. That excess profit technically called as super profit. Super profit. Super profit. Super means above. So over and above the normal profit, there is a super profit. And a value is placed on this super profit. And that is called goodwill. And in the books, only purchased goodwill will be shown. Internally raised goodwill will not be shown in the balance sheet. That is why as per accounting standards, internally raised goodwill cannot be shown in the books. So there are two definitions for goodwill. One is excess purchase consideration paid over net separable assets taken over. And another one is based on the super profit, excess earning capacity. The value placed on the excess earning capacity of a business. So this definition covers everything you need to know about goodwill. It is the value, that means goodwill is having some value. It is in respect of reputation. Reputation means advantages. Advantages or benefits. Advantages over or benefits over other companies in the similar industry. Advantages or benefits. In respect of profits expected in future. Profit expected in future is called future profit. Future profits. While solving problems, we call it as future maintainable profit. Future maintainable profit. This future profit over and above the normal level of profit. Normal level of profit means the profits, the normal profit expected by the investors. Investors' expectation. Investors' expectation. Or yield expected by the investors. Yield expected. Or normal rate of return. Normal rate of return. All are same. This definition covers future profit, profits expected in the future over and above the normal return. Normal return is calculated on the capital employed. So capital employed is also to be considered. Capital employed. So it is primarily based on future profit. What the new owner can maintain in the future. That is called a future maintainable profit. The new owner can maintain only those profits which he can expect. So that expectation depends upon several factors. Then next one is capital employed. This capital employed is very important thing. Here it is called net worth. Net worth in respect of valuation of goodwill. Net separable assets acquired. While calculating this capital employed, non-operating investment should be eliminated or not considered. Non-trade investments. Non-trade investments should be excluded. Why it is excluded? The new owner cannot maintain this. Only operating profit he can maintain. And here we can say future profit is otherwise called as operating profit. Operating profits. Future operating profits. Suppose the future profit of a business is rupees FMB is equal to rupees 1,40,000. And the normal rate of return is an average investor can expect from his investment. It may be pure bank rate plus certain percentage as risk return. So investors' expectations say 10%. And if the capital employed is rupees 10 lakhs, we may calculate this super profit. And this expected future should be in excess of normal profit over excess of actual profit over normal level of profit. What is normal profit? Normal profit is equal to 10% is the normal expectation. Capital employed is 10 lakhs is equal to rupees 1 lakh. Rupees 1 lakhs. 1 lakh. And excess profit is how much? 1,40,000 minus 1,40,000 minus 1 lakh is equal to, so excess profit or super profit. Super profit is equal to 1,40,000 minus 1,40,000. And a value is placed on this 40,000. And there are different methods for valuation of goodwill. So goodwill is always talking about some extra profit. Where there is extra profit, there will be goodwill. Where there is no extra profit, there is no goodwill. But sir, there are several methods for valuation of goodwill, where super profits are not considered. But in reality, goodwill is the value placed on the extra earning capacity of any business. If there is an extra profit, goodwill may be there. Otherwise, and this reputation or the advantages may be on account of several factors. Several factors. The major elements or components of goodwill are dog goodwill, cat goodwill, rat goodwill, and rabbit goodwill. What is the character of a dog? A dog always follows the master. Wherever the master goes, he will follow him. And this goodwill is based on personal skill or reputation of the owner. Personal skill and reputation. A person have a personal skill, special knowledge, special skill. If that person moves away from this business, the goodwill also follow him. And this type of goodwill can be seen in professional firms, architects, lawyers firm, or accountant firms, where one or two persons may enjoy certain reputation. On account of reputation only, this profitability depends. We already studied, where there is super profit, there will be goodwill. The profitability is the important factor affecting, one of the important factors affecting the value of goodwill. This profitability in turn depends upon several factors, certain advantages or benefits. And these advantages or benefits may be on account of personal skill, then we can call it as dog goodwill. It has no value. It cannot be transferred from one person to another. Personal skill cannot be transferred, or personal reputation cannot be transferred. But if it is a partnership firm or a joint stock company, anything, the next goodwill is cat goodwill. What is the character of a cat? A cat never follows the master. He hovers around a particular place. So the goodwill on account of locational advantage. And this goodwill is called local goodwill. On account of traders' premises. Example, we can say that a retail shop situated in the heart of the city is an example of cat goodwill. It can attract more customers and thereby enjoys more profit. Goodwill always increases the profit. Some extra earning capacity is there. This extra earning capacity is on account of personal skill or reputation. It may be called as dog goodwill. If this extra earning capacity based on the location of the business, it may be called as cat goodwill. Then next is rat goodwill. A company or a firm may enjoy certain advantage over the other on one of the several products they deal in. Reputation of the goods sold. This is one of the best example of rat goodwill. Then rabbit goodwill means, what is the character of a rat? Rat always hide below a particular thing or commodity. The reputation on account of goods sold or commodity dealt with. This is an example of rat goodwill. Then rabbit goodwill. Rabbit, what is the character of a rabbit? Whoever shows him a green leaf, he follows him. That is the nature of rabbit. And this is the real goodwill. Transferability is there. Technical know-how is the best example. Whoever pays money, the technical know-how can be easily transferred. There is no geographical limit, nothing is there. Or absence of competition. Where there is no competition, If that business is bought by another person, he may enjoy the whole goodwill. He may enjoy the profitability. Goodwill always means profitability, the extra earning capacity. And there are several factors influencing the valuation of goodwill. The important factors are profitability. Where there is profit, there will be goodwill. Otherwise, no goodwill. And this profitability should be compared with the yield expected or normal rate or capital employed. So profitability, yield and capital employed are the three important factors influencing the value of goodwill. This normal rate multiplied with the capital employed, we get normal profit. And this excess of future maintainable profit over normal profit is called super profit. And the value is placed on the super profit, we get goodwill. We need to solve some problems. If we stuck on theory topics, it will take several hours. Valuation of intangible is very, very important. Nowadays, you go to California, there are several thousands of software companies are there. Thousands of software companies. They don't have any tangible fixed assets. Almost 95% of the assets constitute intangibles. So valuation of intangible is very important. Accounting Standard 26 clearly states everything. And there are several methods for the valuation of goodwill. If there is profit, there is goodwill. On the basis of this average profit, there are two methods. Purchase of average profit method and capitalization of average profit method. But in reality, these two methods are not following. And in the definition itself, we talk about a super profit, excess profit, the extra earning capacity of a business. The profits may be either simple or a weighted average. Simple average profit is obtained by dividing the total profits by number of years. Total profits by number of years. Here the profits given are 4,000, 5,000 and 6,000. So add all these together and divided by 3, we will get a simple average profit. And this simple average profit is then multiplied with the number of years purchase price, we will get a value of a goodwill. Then under weighted average profit is obtained by dividing total products by total weight. A total product obtained by how? Each year's profit should be multiplied with the weights given in the question. So 4,000 into 1 plus 5,000 into 2 plus 6,000 into 3. It is like this. 4,000 plus 10,000 plus 18,000. 32,000 we got. Then divided by total weights. Total weights given are 1 plus 2 plus 3. So divided by 32,000 divided by 6, we will get the weighted average profit. And this weighted average profit is multiplied with the number of years purchase price, we will get the value of a goodwill. And here the average profit means average adjusted profit. That will be studied later. Thus goodwill is equal to average profit multiplied with the number of years purchase price. Number of years purchase price. So under this method, goodwill is equal to average future maintainable profit into number of years purchase price. The average FMP will be either simple average or a weighted average. And under the super profit method, what is super profit? Super profit is the excess of average future maintainable profit over normal profit. And that is based on a certain percentage on the yield expected by the investors on the capital employed in the business. And we need to study about capital employed and yield. So under the super profit method, goodwill may be purchase of super profit or capitalization of super profit. Number of years purchase price. Super profit into number of years purchase price. These are all simple things. The only thing is you have to calculate future maintainable profit and capital employed. That should be studied in detail. This another method is annuity method. Annuity method. Under the purchase of average profit method, goodwill is equal to adjusted average future maintainable profit into number of years purchase price. Average profit may be either simple or weighted. And 3 steps are required. Calculate adjusted future maintainable profit. That is very important. Get the average profit. This average profit may be either simple or weighted average. Simple or weighted average. And value of the goodwill is equal to what? Average profit into number of years purchase price. Number of years purchase price will be given in the question. The next one is capitalization of expected average profit method. While solving problems, we will study this. The next one is super profit. Super profit is the excess of actual average future profit over the normal profit. So we need to calculate average future maintainable profit, then super profit, this excess of and this super profit may be multiplied with the number of years purchase price, or an annuity rate will be given, it will be multiplied with that. And there are several variants of the super profit method. Purchase profit method, capitalization of super profit method is there. Under the capitalization method, super profit is capitalized by the rate of return given in the question. Simple. Annuity method is also there. And we need to calculate capital employed. We need to study more about capital employed and future maintenance. That is the very important topics in this valuation of goodwill from accounting point of view. And theory topics we covered very little only. Otherwise, the topics will be too lengthy. Theory you study from your text very well. And if there is any doubt, mail me. Otherwise, I will upload one theory topics alone on goodwill. Later. Okay. So, we will go for calculating average future maintainable profit and capital employed. And this capital employed in advanced topics only we will study. Otherwise, the capital employed will be given in the question directly. So, capital employed is a special study and we will study it later in this topic. And now we will study what is future maintainable profit, how it is calculated. Adjusted average future maintainable profit. While calculating average future maintainable profit, the start point should be profit before tax. Profit before tax. Start point is profit before tax. If profit is already deducted, that deducted tax should be added back to the net tax profit. Profit before tax, add tax deducted. Add tax deducted. We will get the profit before tax. So PBT should be the start point. Start point. So in this case, different situations may arise. One situation is, see in this question, consider the following figures so and so. 1999-2000, profit after tax 61,000 and the taxation is 20,000. The amount of tax is given. Next, 46,000, 30,000. If the tax amounts are given, it should be added separately. If the tax rate is given, we can simply gross it up. Tax rate is equal to, say, 61,000 into 100/50, if tax rate is 50%. We can gross it up, simply gross the profit. But here the tax amounts are different in each year. In such a case, we should add back the profit separately. Add back the profit separately. So years we may give years, say 61,000 add tax. How much is the tax? 20,000. And next year 46,000 and 30,000. And add this together, we will get the profit before tax. PBT 81,000, 76,000. So in this case, profit before tax for the years, we have to write like this. Calculation of adjusted profits and future maintainable profit. Then add to this taxation already deducted. How much it is? 20,000, 30,000, 25,000, 40,000 and 38,000. Adding this together, 81,000, 76,000, 65,000 and 85,000, 96,000. And this is profit before tax. The tax rate is given, we can simply gross it up. We will arrive at the profit before tax. So profit before tax should be the start point. So PBT we arrived at profit before tax. Then the next step is, first each year's profit should be adjusted with the past items. Past items. Items incurred in the past. For example, non-recurring and non-operating expenses and losses incurred in the past. Non-recurring, non-operating. Examples are loss by fire or theft, loss by earthquake, loss by earthquake. These are all past non-recurring and non-operating expenses. Example, loss by fire or theft and earthquake. For example, in this question, X Limited proposed to purchase the business of Y. Goodwill is to be valued at 3 years purchase of the simple average profit and weighted average profit, etc. Then profits for certain years are given. On scrutiny of the account, the following matters are revealed. See, in the year 2015, there was an earthquake due to which the business lost property worth 11,000 rupees. And this is a non-operating loss. Also, there is little chance to recur it. It is a non-operating loss. We are calculating future maintainable operating profit. So, non-operating losses and expenses incurred in the past are to be adjusted. Here saying, in 2015, there was an earthquake and 11,000 rupees worth of property has been lost. And the same should be added to 2015 profit. 2015 profit how much? 1,05,000. So, we have to calculate the future maintainable profit. This amount should be added to the 2015 profit. It may be done as 2017 and loss by earthquake. Loss by earthquake. The amount should be added to 2017 profit 11,000. This adjustment may be done like this. Calculation of adjusted profit and future maintainable profit. Profit as given. See, profit as given. Add non-operating loss. Non-operating loss here is loss by earthquake. In which year? 2015. 11,000. It is a non-operating loss. Operate. It is not on account of trade or normal business operation. It is a loss on account of earthquake. It should be added back to the year's profit. All the past incurred items should be adjusted. Here, the profit is reduced by this extraordinary loss. Extraordinary loss or non-operating loss. We may call it as non-recurring also. There is only little chance for another earthquake. So all these non-operating and non-business losses and expenses should be added back. And again saying in the year 2017, a fire occurred in the premises of business and the stock worth 12,000 rupees has been lost and the stock was not insured. This is also non-operating or non-recurring or non-business loss or extraordinary loss. In the future, it may not arise. Otherwise, it is a non-operating loss. All non-operating, non-recurring expenses and losses incurred in the past should be adjusted to each year's profit. In 2015, loss by earthquake, 11,000 rupees. Loss by earthquake, 11,000. 11,000. Then another loss by fire. Add loss by fire. The stock was not insured and nothing has been received from the insurance company. Which year it has happened? A fire occurred in the premises of the business and stock worth rupees 12,000 has been lost. 2017. Loss by fire. That should be added back. 12,000. Then all the past profits should be adjusted with the past items. The first one is non-recurring and non-operating expenses and losses should be added. Examples: loss by fire or theft, earthquake, etc. Then there may arise certain adjustments. Stock adjustments may arise. This is not a non-operating, it is an operating adjustment. For example, the stock of any year is overvalued or undervalued. The stock is overvalued. What is the result? Profit is overstated. So that year's profit should be deducted by this overvaluation. And in the next year, opening stock is what? Overvalued. So that should be added back to arrive at the trading profit, operating profit. So these rectification and adjustment should be done in each year, the year in which it has occurred. So all the year's profit should be adjusted with the non-recurring and non-operating expenses and losses incurred in the past. It may be adjusted to 1 or 2 years only. But future items should be treated separately. All the past items should be adjusted first. Another thing is, all non-recurring and non-operating incomes and profits earned in the past should be deducted. Examples are: the profits of 2017 included non-trade income from non-trade investments. It is a non-operating income. The new owner can maintain the future profit. This future profit means operating profit. So, all the expenses and losses incurred in the past, non-recurring and non-operating expenses incurred in the past, should be added, and all the non-operating or non-recurring incomes should be deducted. That is the adjusted profit. Examples of non-recurring and non-operating incomes are income from non-trade investments included in any particular year's profits, or government subsidy. The question may say, in the year 2015, the firm has got a government subsidy of 5,000 rupees. It is non-recurring. Compensation received other than trading, that is also another example. Compensation received by the business. So these are all non-recurring or non-operating incomes. The new owner can maintain operating income in the future. So all the past year's profit should be adjusted in the light of informations given in the question. Non-operating expenses and losses incurred in the past, they are extraordinary, we can say. Extraordinary items should be adjusted with each year's profit. It is not uniform. It may include loss by fire, theft, etc. Incomes or profits included income from non-trade investments received in any particular year. And in this way, we have to adjust each year's profit. Then we will take the net figure. After taking the net figure, future items should be adjusted. Future items. What is that? Future items. Thus, we have calculated the adjusted profit. Adjusted profit here is the profits of each year should be adjusted with the non-recurring and non-operating expenses and losses. After finding out the adjusted profit, then the next step is find out the average profit. This average profit should be either simple or weighted average. After ascertaining the average profit, we have to adjust these items. Expenses not likely to be arised in future. From the adjusted profit, future items should be adjusted. The first one is expenses not likely to be arised in future. Example, retiring manager salary or manager whose service is no longer required. Suppose one person is purchasing another business and he is now decided to replace the old manager with himself. This is a case, expenses not likely to be arised in future. The manager's salary not likely to be arised in future. Not likely to be arised in future. So in this case, the retiring manager or replaced manager's salary should be added to the average profit, average adjusted profit. Otherwise, you have to show it in all the years. So expenses not likely to be arised in future should be added. Old manager's salary. Then assets may be revalued. Under capitalization method, sometimes fixed assets may be revalued. In this case, the loss on revaluation will come. Some fixed assets may be valued less than its book value. In that case, the difference of the depreciation on the loss of fixed assets should be treated as excess depreciation. Now, there is a savings in respect of depreciation. That savings should be added back. That is called excess depreciation provided earlier. That should be added to the adjusted profit. This adjusted profit. Average adjusted profit. Only once. Otherwise, you have to write this figure, excess depreciation or retiring manager's salary, in all the years. Both are same. Then find out the average. Another item to be added is incomes or profits likely to be arised in future. Profits expected from new line of business. That we will do a problem separately for that. Profits expected from new line of business. That should be adjusted. Then less expenses and losses likely to be arised in future. Example. See, in this question, now Excel Limited decided to insure the stock against fire and theft and a premium estimated at rupees 300 per annum. This is an expense likely to be arised in future. So this insurance premium should be deducted from adjusted average profit. The profits are not averaged. You have to write this 300 rupees in all the years as a expenses likely to be arised in future. Future management cost. Future management cost. Fair remuneration of the proprietor. Fair remuneration of the proprietor are examples of expenses likely to be arised in future. Now in this case, we have to add this 300, deduct this 300 rupees from expenses likely to be arised in future. Others are additional depreciation. If assets are appreciated, there is an additional depreciation may arise. Additional depreciation. And this additional depreciation should be deducted from the average adjusted profit as an expense or loss likely to be arised in future. Otherwise, you have to write this additional depreciation in all the years in question. Additional depreciation is an expense likely to be arised in future. Managerial remuneration to be provided. Future management cost. Then the old manager's salary should be added back. Future manager's salary should be deducted. We are calculating future profits. In the future, the retiring manager's salary is no longer payable, so that should be added and the future management cost should be deducted. Simple. Additional depreciation should be deducted from the future profit. Managerial remuneration to be provided, that is future management cost. Fair remuneration of the proprietor. These are all expenses likely to be arised in the future. So from the average adjusted profit, we can deduct or add these items. Expenses not likely to be arised in future should be added. Incomes or profits likely to be arised in future should be added, and expenses and losses likely to be arised in future. Expenses likely to be arised. It is an expense. So that should be deducted from the adjusted profit, average adjusted profit. Expenses likely to arise in future includes additional depreciation, managerial remuneration to be provided or future management cost, and fair remuneration of the proprietor. And adding and deducting, we get average adjusted future maintainable profit. And from this average adjusted future maintainable profit, deduct taxation at the new rate given in the question. That is why we started with the profit before tax and end with profit after tax. That is the profit that can be maintained in the future. And all these items we will discuss more than 100 times in this chapter. expenses likely to arise in future. All these will be discussed later. And this way, we have to calculate the future maintainable profit. Text and solutions. First one is valuation of goodwill. The goodwill is valued at 2 years purchase of average profits. Okay. X purchased the business of Y on 30th June 2001. The profits earned by Y for the preceding years ending 31st December each year were 98, 44,000, 99, 41,000 and year 2000 it is 45,000. So we first calculate future maintainable profit. And this future maintainable profit multiplied by number of years purchase price, we will value of goodwill is here 2 years purchase of average profits. So we will calculate future maintainable profit. Future maintainable profit. First, write all the years. What are they? 1998, then 1999 and 2000, 3 years. Profits are 44,000, 41,000 and 45,000. No tax adjustment is there. So we can ignore tax. Then what are all the adjustments? It was ascertained that profits of 98 included a non-recurring item of rupees 1,000. So this 1998 profit 44,000 includes a non-recurring item. Profits included a non-recurring item means it is an income. So there is a non-recurring income in 1998. First we have to adjust each year's profit. Each year's profit with the past items. It was ascertained that 1998 included a non-recurring item of rupees 1,000. All non-recurring incomes and gains should be deducted. Incomes and gains should be deducted. So this is an item to be deducted. Non-recurring income. Rupees 1,000, year 1998. We are calculating future maintainable profit. These non-recurring incomes are excluded. The profits of 1999 was reduced by 1,500 due to an extraordinary loss on account of theft. So this item should be deducted. Deducted non-recurring income 1,000 rupees. And this item 1,500 due to an extraordinary loss on theft. Extraordinary loss of theft. So this is a non-recurring as well as a non-operating loss. Better say non-operating loss. And these non-operating losses should be added back to the profit to find out the operating profit. So this item should be added to year's profit. Add 1,500 loss on theft. Correct? Loss on account of theft. How much? Rupees 1,500. And that was in the year 1999. The next, properties were not insured and it was thought prudent to insure the business in future. This is what? Expenses likely to be incurred in the future. Expenses likely to arise in future. In 99, a loss on account of theft has happened, and now it is decided to insure the business in future, and the premium estimated at 150 per annum. This is an expense likely to arise in future. What to do? It should be deducted from average profit. Average adjusted profit should be again adjusted. Expenses likely to arise in future. How much? Insurance premium. Rupees 150 per annum. 150. Deducted from average profit. X at the time of purchasing the business was employed with A Limited and was getting rupees 400 per month. This is fair remuneration of the proprietor. Before purchasing the business, he was employed with some other company and was getting a salary of 400 rupees per month. So this is called fair remuneration of the proprietor. Fair remuneration of the proprietor should be treated as an expenses likely to arise in future. Here what? Fair remuneration. Rupees 4,800. That is 400 into 12. 400 per month into 12. He intends to replace the manager of the business who at present is getting 250 per month. And this manager, he wants to replace the manager. So this manager's salary 250 per month is an expense not likely to arise in future. So expenses not likely to arise in future. That is manager's salary. That should be added to average adjusted profit. Rupees how much? 250 into 12 is equal to how much? 3,000. 3,000. It was found that closing stock for the year 99 was overvalued by rupees 1,200. So it is a past item. This past item should be adjusted in the year or years in which it has occurred. In 99, closing stock was overvalued. So when closing stock is overvalued, what will happen? Profit is overstated. That rectification should be done. So it is a rectification. Rupees 1,200 to be deducted from which year? 1999. Less overvaluation of closing stock. And also, if closing stock of 99 is overvalued, it has an effect in the opening stock of year 2000. Year 2000 is here. If opening stock is overvalued, the year 2000 profit is underestimated. So the same amount should be added back to year 2000 profit. So add it to year 2000 profit. Then future maintainable profit is calculated, multiplied by 2, we will get the value of goodwill. Under average profit method, goodwill is valued at average profit into, average profit here means average future maintainable profit into number of years purchase price. That is called future maintainable profit. Future maintainable profit into number of years purchase price. This future maintainable profit calculation. Year 98, 99, 2000. Profit as given, no tax adjustment required, 44,000, 41,000, 45,000. Yes. Add loss by theft. This is a non-recurring loss. We are calculating future operating profit. So this non-recurring loss should be added back to the year's profit to find out operating profit. So this is added. Less non-recurring income. Non-recurring income should be deducted because this 44,000 includes this non-recurring income. That should be deducted. Less overvaluation of closing stock in the year 99. Stock is overvalued. That means profit is overstated. So that should be deducted in the year 1999. And in 2000, the opening stock is overvalued. When opening stock is overvalued, it decreases profit. So that adjustment should be done in the year 2000 profit. So add overvaluation of opening stock. So past adjustments are over. We can total it and take out the average. Average profit is equal to total profit divided by number of years. That is 43,000 plus 41,300 plus 46,200 is equal to 1,30,500. Divided by 3, we will get 43,500. From this average adjusted profit, we can deduct expenses not likely to arise in future. We have calculated that. What is that? X at the time of purchasing the business was employed with A Limited and was getting 4,000 rupees per month. This is fair remuneration of the proprietor. Per month he was getting 400. So that fair remuneration should be deducted from average profit. Else you have to show 4,800 in each year. 44,000. And he intends to replace the manager of the business, who at present is getting 250 per month. The manager is getting 250 per month. That is 3,000 rupees per annum. And this manager is no longer in the business. So that amount is an expense not likely to arise in future. And expenses not likely to arise in future should be added back to the average profit. For all the 3 years you have to show it. Here, manager's salary, expenses not likely to arise in future. 250 per month into 12 months, it will be 3,000. 46,500 we got. Then expenses likely to arise in future are fair remuneration of the proprietor and stock insurance premium. That is deducted. We get a future maintainable profit. This future maintainable profit into 2, we will get a goodwill. And these items you can show in other way. How? See. Fair remuneration of the proprietor, adjustment required for all of the years. 4800 should be deducted from each year. Less insurance premium expenses likely to arise. 150, 150, 3000, 3000. There also we will get average profit, future maintainable profit, 41,550. Here also 41,550. Alternatively, this is the professional way. Alternatively, we can show like this also. All the future items should be deducted or added to each of the years. Each of the years' profit should be adjusted. And this is the magic of average. Whether it is weighted average or simple average, it makes no difference. Then we have to calculate goodwill. Goodwill is equal to future maintainable profit into number of years purchase price. 41,550 into 2, that is 83,100. 83. That is the value of. Then second method is at 2 years purchase of super profits. At 2 years purchase of super profits. Normal rate of return is given. Capital employed also given. What is super profit? Super profit is super profit is equal to future maintainable profit minus normal profit. Correct? FMB is minus normal profit. That is super profit. So here FMB is equal to 41,550. Less normal profit is 3 lakhs into 10%. Normal profit is equal to 3 lakhs into 10 by 100. 10% is the normal rate of return. Is equal to 30%. Equal to 30%. So FMB minus 30,000, we will get a super profit. That is FMB is equal to 41,550 and normal profit is equal to 3 lakhs into 10 by 100. We will get 11,550. 11,550 into number of years purchase price. Super profit. Goodwill under super profit. Under capitalization of super profit method, goodwill is equal to super profit divided by normal rate of return. Here, how much goodwill? Goodwill is equal to super profit by normal rate. How much is super profit? 11,550. This into 100 by